Hey everyone, it's Nismo, and welcome back to the channel. Today, we're diving deep into the world of fundamental analysis, the bedrock of intelligent investing. Forget the hype, forget the trends. Today we're talking about understanding the true value of the businesses you're buying into. That's right, when you buy a stock, you're not just buying a ticker symbol, you're buying a piece of a real company. Over the next few minutes, we're going to break down this often intimidating topic into bite-sized pieces. We'll explore the core elements that allow you to look at a company, dissect its financial statements, understand its competitive landscape, and ultimately determine if it's a worthwhile investment. No more relying on gut feelings or following the herd. This is about empowering you to make informed, calculated decisions with your money. Whether you're just starting out in the stock market or you're looking to refine your investing approach, this video is packed with valuable insights to help you invest smarter. So, buckle up, grab your notebooks, and let's get started. First up, we're tackling the foundation of fundamental analysis, a company's financial statements. Think of these as a company's report card, revealing its financial health and performance. We'll be dissecting the three major players: the income statement, the balance sheet, and the cash flow statement. Don't worry, we'll keep it simple. The income statement shows you how much money a company is bringing in, revenue, and how much it's spending, expenses, over a period of time, ultimately leading to its net income or profit. Think of it like tracking your income and expenses every month. Next, the balance sheet, a snapshot in time, tells you what a company owns, assets, and what it owes, liabilities, with the difference being shareholder equity. Imagine it as a financial selfie, revealing a company's net worth at a specific moment. And finally, the cash flow statement, arguably the most important of the three, tracks the movement of cash both in and out of a company. This statement gives you a clear picture of a company's ability to generate cash, pay its debts, and reinvest in its growth. It's like following the money trail to see where it's coming from and where it's going. Now that we've got the basics of financial statements down, let's talk about putting those numbers to work, using financial ratios. These are key metrics that help you compare different companies within the same industry, as well as track a company's performance over time. We'll cover essential ratios like the price-to-earnings (PE) ratio, which tells you how much investors are willing to pay for every dollar of a company's earnings. A high PE might indicate that investors are expecting high growth in the future. We'll also dive into the price-to-book (PB) ratio, which compares a company's market value to its book value, giving you an idea of whether a stock is overvalued or undervalued. And let's not forget about return on equity, ROE, a measure of how effectively a company is using its equity to generate profits. A higher ROE generally suggests better management and a more profitable company. Understanding these ratios and others like them will give you a significant edge in evaluating a company's financial strength and growth potential. Numbers are crucial, no doubt, but fundamental analysis is more than just crunching numbers. It's about understanding the story behind the business. In this chapter, we'll go beyond the spreadsheets and delve into the qualitative aspects of a company, like its business model and competitive advantage. What exactly does the company do? How does it make money? What sets it apart from the competition? This is where we talk about economic moats, those durable competitive advantages that protect a company's profits from competitors. Think about companies like Apple with its brand loyalty and ecosystem, or Amazon with its massive scale and distribution network. These moats provide a sustainable edge, allowing them to thrive in the long run. Remember, we're looking for companies that are built to last, not just flash-in-the-pan trends. Chapter 4. The Leaders of the Pack. Evaluating Management and Governance. A company is only as good as the people running it. That's why assessing the management team and the board of directors is a crucial step in fundamental analysis. Think of it like this: would you invest in a ship without a captain, or even worse, with a captain who has a history of running ships aground? Probably not. We'll look at the track record of the CEO and the management team. Have they successfully navigated the company through challenging times? Do they have a clear vision for the future? Are they aligned with the interests of shareholders? Equally important is the board of directors. Are they experienced, independent, and holding the management accountable? A strong and ethical leadership team can make or break a company, so pay close attention to who's at the helm. Chapter 5. Riding the wave. Analyzing industry and sector trends. Even the most well-managed company can be swept away by a changing tide. That's why it's crucial to understand the industry and sector trends that can impact a company's future. Is the industry growing or shrinking? Is it ripe for disruption? Are there any regulatory changes on the horizon? For example, the rise of e-commerce has been a huge tailwind for companies like Amazon, while simultaneously disrupting traditional brick-and-mortar retailers. By analyzing these trends, you can identify companies that are well-positioned for growth and avoid those that might be heading for troubled waters. Remember, it's not just about picking a great company, it's about picking a great company in a great industry. Chapter 6. The bigger picture. Navigating economic indicators. Now let's zoom out and look at the macro-level factors that can influence the entire market and, by extension, individual stocks. This is where we talk about economic indicators, things like interest rates, inflation, GDP growth, and unemployment. Understanding these indicators can give you valuable insights into the overall health of the economy and its potential impact on your investments. For instance, rising interest rates can make it more expensive for companies to borrow money, potentially impacting their growth prospects. Similarly, high inflation can erode consumer purchasing power, impacting company profits. By keeping an eye on these economic indicators, you can better anticipate market movements and adjust your investment strategy accordingly. Remember, even the best companies can be affected by a downturn in the economy. Chapter 7. Staying ahead of the curve. Decoding news and catalysts. The stock market is a dynamic beast, constantly reacting to news and events. In this chapter, we'll discuss how to stay informed and analyze the impact of news events on stock prices. This includes things like earnings announcements, product launches, mergers and acquisitions, regulatory changes, and even geopolitical events. We'll explore how to separate the noise from the news that actually matters to your investments. For example, a company beating earnings estimates might send its stock price soaring, while a product recall could send it tumbling. By understanding how to interpret and analyze these events, you can make more informed decisions about when to buy, hold, or sell your investments. Remember, knowledge is power, and in the stock market, staying informed can give you a significant advantage. Chapter 8. The million-dollar question. Calculating intrinsic value. Now for the moment you've all been waiting for. Calculating intrinsic value. This is the holy grail of fundamental analysis, the process of determining what a company is actually worth, regardless of its current stock price. We'll explore two widely used methods: discounted cash flow, DCF, analysis, and the dividend discount model, DDM. DCF involves forecasting a company's future cash flows and discounting them back to their present value, while DDM focuses on the present value of future dividends. These methods provide a framework for estimating a company's intrinsic value, allowing you to identify undervalued opportunities and avoid overpaying for stocks. Remember, buying stocks below their intrinsic value is a key principle of value investing, and these tools can help you do just that. Outro. Your journey to financial freedom starts now. And there you have it, a crash course in fundamental analysis. By mastering these core elements, from deciphering financial statements to understanding business models, evaluating management, analyzing industry trends, and calculating intrinsic value, you're well on your way to becoming a more informed and confident investor. Remember, investing is not about getting rich quick, it's about building long-term wealth through carefully researched and well-timed decisions. Understanding the true value of your investments is the key to success in the stock market. So, keep learning, keep exploring, and never stop asking questions. And as always, if you found this video helpful, please give it a thumbs up, subscribe to the channel for more insightful content, and hit that notification bell so you don't miss out on future videos. Thanks for watching, and until next time, happy investing!